Today is Friday, October 6th, 2023, and we had a very full week, so let's jump right in. Opening up the first full week of October came a lot of economic data and big swings in interest rates, as equities saw large swings as well, but ultimately ended lower on the week. As of close Thursday, October 5th, the Nasdaq Composite fell 0.66%, the S&P 500 fell 0.7%, and the Dow Jones Industrial Average fell about 0.94% for the week. This was a very eventful week, so heading right in, we got the ISM Manufacturing and Services Indexes this week. The manufacturing industry showed a contractionary week again, as the PMI for September posted at 49% there. This marked a 2.9% increase from August 47.6% reading, but is still in negative territory overall. All this comes as certain technical indicators begin to point to a more neutral industrial sector and less of a bearish view on the industry, which is all obviously dependent on macro conditions. So really interesting stuff, as the manufacturing industry might be gaining a little bit more traction compared to where it was when we had these consistently really low readings on the PMI, but we'll just have to see how it plays out in this macro environment. Along with the ISM Manufacturing Index, the ISM Services Index came out this week as well, posting another month of a positive services industry. The September Services PMI rang in at 53.6% for the month, which was down slightly from August reading of 54.5%. Also really notable in this report that the Services Employment Index indicated a much hotter employment market, with 85.9% of respondents saying that the employment opportunities in the services sector were either the same or better in the month of September. So really interesting there, and we will see the data follow that when we get to the employment situation later on in this presentation. Another idea we've seen in the markets and seeing a lot of consumers deal with is the idea of home affordability and how much more expensive it really has gotten in the last 3 years to be able to buy a home. So mortgage rates are hitting 20-year highs, with the 30-year fixed rate mortgage above 7%. And the home prices have also stayed elevated since the pandemic as well. When you look at the median existing home in 2020 with a 20% down payment and an average 30-year mortgage rate, 2020 that clocked in just under $1,000, but then you clock in these numbers in 2023 with a existing home being the median price of $407,000, much higher than 2020, and the 30-year mortgage rates above 7%. This monthly payment would clock in at $2,300. So buying just a median average home in the last 3 years has more than doubled in the monthly cost, given the higher interest rates as well as higher home prices. On that same note of higher interest rates, we've seen some really interesting movements in the yield curve, specifically the 10-year minus the 3-month Treasury spread that is most commonly tracked for Treasury yields. Here you can see in about June, it has begun a process of de-inverting, we think, and this is typically a pre-recessionary indicator. Here you can see in the late 1980s, the yield curve peaked at a bottom there. Then it begun to de-invert, and that's when we began a recession in the early 90s. Then in the dot-com bubble of the early 2000s, we saw that same trend. We saw the inverted yield curve peak, and then it begun to de-invert as the gray here, the recession begun. Same thing in the financial crisis of 08-09 era. We saw the yield curve go down, peak, then begun disinverting before the recession happened. So here, also in the COVID pandemic, we saw that same trend, a peak in the yield curve, then a increase of it, the inverting, and then a recession. Even though that recession was very interesting, kind of more of a black swan event, still followed that same trend. Here you can see we have had the most severely inverted yield curve, and we are moving upwards. So that kind of leads us to think we are in one of these gray recessionary periods in the next 12 months or so, if history follows its course. Another way we like to look at the yield curve is just comparing, where the yield curve was on one day compared to where it is currently. So here we see the January 1st yield curve in the gray here, where we were beginning out the year. And you can see how we have moved up in pretty much every aspect of the yield curve, longer term, shorter term, treasury yields, everything. But the steepness of the inversion has become a little bit less steep as we saw in that 3-month 10-year spread in the previous slide. So anyways, this will continue to be a key indicator that we keep an eye on as we keep a macro perspective on the economy and how we position our portfolios. Final update of the week, probably the most notable, is the September employment situation. We saw a big surprise to the upside in Friday's jobs reports for the month of September, clocking in non-farm payroll at 336,000 new jobs in the month compared to estimates of less than 200,000 jobs. This marked the highest monthly increase of jobs since January this year, making it a quite notable report for an economy that the Fed is really trying to slow down the brakes on. So really interesting stuff. On top of non-farm payroll, the unemployment rate remained the same in September at 3.8%, so no changes there. And the average hourly earnings rose actually less than expected at a monthly increase of 0.2%. So for an economy that many thought would have already been in a recession by now, employment markets definitely are not in a recession. However, we will continue to monitor this as it could quickly shift. So thank you so much for tuning in to our market update this week, and we look forward to providing another one next week.